Hello, everyone, and welcome to day 4 of Audit and Assurance Revision. Today, we are going to do one more very important topic, and that topic is substantive audit procedures. Now, it's a general perception that only the audit risk and auditor's responses is important, and only deficiencies, controls, and test of controls is important, whereas substantive procedures doesn't have weightage, but it is wrong. And today I will teach you how to identify substantive procedures, what are substantive procedures, and how do you solve a question which has substantive procedures. Now, this can be a part of your question or an entire question on substantive procedures. So it is very, very important. So let's begin with that. Yeah. Now, substantive procedures or audit procedures can be asked on anything. It can be asked on cash and bank, it can be asked on receivable, it can be asked on payable, it can be asked on payroll, it can be asked on anything, it can be asked on plant and machinery, anything. Now, the ones that we know, like cash and bank, receivables, payables, we will like mug it up and go. But depending on the question, if there is something new that is happening, a new investment, and if they tell you to write substantive procedures on that, and for example, you don't know, you have not prepared for that, in that situation, what to do? These are the general substantive procedures, standard substantive procedures. You have to inspect documents and records, yes, for to have an idea of inquiry and reliability, inspection of tangible assets, yes, confirmations from third parties, confirmations from the management. You have to conduct CAT, computer assisted auditing techniques, to kind of solve the question faster. Observation of process or procedure being performed by others. Recalculation, because we are auditors and we cannot trust the management directly, so at least for a sample of items I have to recalculate things either manually or electronically to confirm the arithmetic accuracy of the same. Yes, reperformance by the auditor of the controls originally performed as a part of entity's internal control system. So it's like the management has performed certain things, but I will re-perform it and see if they're good, if whatever the management has done is proper. One thing is, the management will tell you a lot of things about the company, that we are doing this, we are doing that, we are engaged in this, we are engaged in that. But the thing is, we will not listen to everything that the management says, because at the back of the mind, the auditor should know that management is an internal part of the organization, and management will try his best to speak good about the organization, but the auditor should come with a lot of questioning mind and a professional skepticism, wherein I will find out myself as an auditor if the documents and records are proper. So I will inspect the documents and records. I will myself go and inspect the tangible assets. So in the books of accounts, if the management is saying that we have assets worth rupees 1 crore, I do not know if this is true or not. So I will myself visit the godown and I will check the assets. I will check the valuation of assets and I will make sure that yes, the assets are worth 1 crore. I will have confirmation of the third parties. For example, if the management tells me that we have a loan of 10 lakhs, I cannot take it. I cannot trust the management easily. So I will go to the bank. Bank is a third party, and I will obtain a confirmation from the bank that yes, the bank has given the loan to the company, or any other such thing. If the company has ties with some third person, I will go to the third person and confirm the same if the company is speaking the truth. With this, I will also get an idea of how strong the company's internal controls are, and then I can decide whether I want to place a reliance on that or I don't want to place. Next I will do is CAT, computer assisted auditing techniques. whatever calculations, whatever procedures the management has done, once again I'll do it using the computer. And using the computer assisted auditing techniques, whenever we conduct procedures, it becomes easier. Because for computer assisted auditing techniques, the procedures are carried out just by the click of a button. So you do not have to like organically do everything. The computer does its work, you just have to give the command. So again, by CAAT, that is computer assisted auditing techniques, you can check if whatever the management is saying is true or false. Okay, the best thing that you can do is observation. The management will tell you a lot of things, that in the company we are doing this, in the company we are doing that. Observe and see if they are really doing those things. Okay, observation is very important. Then recalculation, manually or electronically. Whatever figures are there in the books of accounts, they are the calculations by the management, right? You will not trust every figure that is there. On a random basis, you will pick figures, like you will pick a figure of building, you will pick a figure of bad debts, and you will recalculate it either manually, like yourself, or you will do it electronically using the computer assisted auditing techniques and find out the arithmetical accuracy of that. So is the management's calculation in that accurate or not? Yesterday we did a question wherein the management, even after calculating the payroll by using computer assisted auditing techniques, for a sample of items they did it manually to check if the machine is doing its job properly. So they were putting the hours input and the machine used to directly calculate automatically the payroll. But the company also selected a sample from that and found out if this calculation is proper. So that is the meaning of recalculation, to check arithmetical accuracy. And the last part we have is reperformance by the auditor of controls originally performed as a part of the entity's internal control system. There are various procedures, there are various controls that are performed by the auditor. Yes, that are performed by the company. Auditor will reperform a few of those to see if they are originally performed as a part of ICS and to see if they are performed correctly. Now these are general audit procedures, and I would want my students to use this if there are substantive procedures on an item which you don't know. So I'm not telling you just to copy paste this, but use your discretion related to the matter, like whatever the matter is, and design your own procedures keeping this as the base. So inspection of records and documents, inspection of tangible assets, confirmation, CAT, observation, recalculation, and reperformance. Keep this as the base. Yes, and when you keep this as a base, depending on what the situation is, you make your own procedures, because procedures have no right or wrong answer. Because I am a different auditor, you are a different auditor, my procedures and my way of working can be different, your procedures and your way of working can be different. Every auditor, depending on his knowledge and judgment, might have different audit procedures. So it depends on what you want to take as audit procedures and what I want to write. But the end result, you need to inspect records to confirm accuracy. You need to inspect tangible assets to make sure that they are actually existing. So the end line, the moral of the story has to be the same. For that, you conduct any procedures that you want. Now, I have audit procedures for so many items, okay? I will just discuss a few in class and then we will solve questions. So, this is audit procedures on directorial testing, yes? This is audit procedures on cash and bank. So, let's do audit procedures on cash and bank. The main thing that we have to find out in cash and bank is if the cash and bank figure actually exists, the accuracy and valuation. For that, what we will do? Recalculation for at least a sample. Then we will do bank reconciliation to check if the cash balance and the bank balance is proper. Yes. Then we will obtain a bank confirmation letter. What is that? Confirmation from third parties. Yes. To make sure that actually there is that much cash or that much balance with the company. External confirmation. Then you will review the cash book and bank statement. For what? As a proof, right? Then what are the key areas to consider? Obtaining a bank confirmation, that is third party confirmation, testing the bank reconciliation to make sure that the cash and the bank balance is same, and reviewing the cash book to see that where you're doing the expenses, how much money is coming in, how much money is going down. So this is the procedures on cash and bank. Now this is just explained diagrammatically. It's further explained like that, and in the exam you have to write it like that. Okay, so the first audit procedure in cash and bank is agree the cash book figure to financial statements. Ideally, whatever figure is there in the cash book should directly go to FS, that is the balance sheet. The company might have done that, might have not done that. Two possibilities. You as an auditor will not rely on the company, but you will yourself check the accuracy of this. So check the figure in the cash book. How much is the figure? That much should be taken to the FS. Okay, go and check the cash book. It is 1 lakh. Now go and check the FS. It is 1 lakh. If the figures are proper, that means your records are accurate. Okay, the first thing, the first audit procedure. Second, obtain a bank confirmation letter from the company's bankers. For what? That means the company is there and their bankers is, for example, XYZ Bank. The company is saying I have taken a loan from XYZ Bank. But I will not trust it. As an auditor, I need to maintain professional skepticism. So I will go to the banker and I will obtain a bank confirmation letter confirming that the bank has really given the loan to the company. And this will give me an idea of the existence of the loan. Yes, that the loan really exists. Completeness of the loan, that the loan has been given to the company. Valuation of the loan, what is the value of the loan, how much is repaid and how much is yet to be repaid, and rights and obligations of the company. Rights are what the company enjoys, obligation is what the company is bound to give back. Okay, so just by obtaining one document, bank confirmation letter, I will get a proof of the existence of the loan, of the completeness of the loan, of the valuation of the loan, and rights and obligation of the loan. Okay, now third procedure, agree balance as per the company bank statement to the original year-end bank statement and also the bank confirmation letter. Ideally, the balance in the balance sheet should agree to the bank confirmation letter. That is, if the company tells you that we have got a loan from XYZ Bank of 1 lakh, XYZ Bank should also say the same. So both should match. The company balance and the bank confirmation letter balance should match. And if they are matching, that will give you an idea of accuracy. That means the company's records are accurate. Okay. Then next, trace all of the outstanding lodgements to the pre-year-end cash book and post-year-end bank statement. Now sometimes what happens is when you're paying an interest, a part of the interest is paid last year, so it will come in the pre-year-end cash book. A part of the interest is to be paid in future. If you remember, yesterday we did a sum wherein whenever there's a loan, you have to close your eyes and write down this risk, because the auditor always has a doubt that the calculation of current and non-current liabilities, the split is not proper. Because if you have a loan of 10 years, whatever is payable within 1 year will be a part of current liability, and whatever will be repaid after that will be a part of non-current liabilities. And the auditor always has a doubt that the company has messed up with this. Same as here. A part of it will be last year paid, a part of it will be paid this year, a part of it next year. Obtain company's bank reconciliation and cast, that is check, to ensure arithmetic accuracy. So again, you open the company's bank reconciliation and ensure arithmetic accuracy. So this was audit procedures on cash and bank. Like that, you have audit procedures on various items. This was just one example. I will give you 2-3 more examples and then we begin with solving the questions. Now, audit procedures on non-current liabilities. Let's look at that. If I want to confirm non-current liabilities. What are non-current liabilities? Something that you have to repay after 1 year. Yes, liabilities that become payable after a year. So the first one, now I've just taken 4 points. If it asks you to write for 6 marks, you have to write 6 good points, or if you're giving very generalized points, you have to write at least 8. Okay, so obtain a breakdown of all loans outstanding at the year end, cast to verify arithmetical accuracy, and agree the total to the financial statement for completeness. Now if you see, the end line always remains the same. You have to ensure inspection, observation, inquiry, external confirmation, recalculation, reperformance, completeness, valuation, rights and obligation, and presentation. This is your moral of the story. Now for these things you have to design procedures, because your end line is completeness, valuation, accuracy, rights and obligation, recalculation, reperformance, inspection, observation, inquiry. So what you will do? You will obtain a breakdown of all the loans outstanding. You will split it between current and non-current liabilities, and you will agree the total to financial statements to ensure that the figure included in the financial statement is complete. Okay, that's one thing. Second, agree the balance outstanding to the bank confirmation letter. Again, same like we had in loans. Whatever is the balance outstanding. Non-current liabilities means what? You have taken a loan and you are yet to repay it. So again, you can confirm with the bank confirmation letter, like confirmation from third parties, if the loan really exists and this is the amount that needs to be repaid. Okay. Inspect bank confirmation letters for any loans listed that have not been included in the financial statement. Again, get a confirmation letter from the bank for any loans that are really there but the company has not recorded them. So if that is the case, that means the completeness is not there. If all the loans are included, only then the loans can be complete. Otherwise the completeness is not there. And last, for allocation, classification and presentation. So for presentation purpose in the balance sheet, current and non-current liabilities are separately disclosed, right? So you have to recalculate the split between current and non-current liabilities. For what? To make sure that the split is correct. For allocation, classification of the split correctly, and presentation purpose. Now next, if you see, it is about non-current assets. One second, no? Yeah. So like that, it is about various items and you can just, go on reading and studying about it. Guys, if you have any doubts, please put it in the comments. I will check the comments right now and I will solve them also. So the next we have is audit procedures on non-current assets. Okay, so what you will do, audit procedures to confirm the non-current assets. You will obtain the non-current assets register of the company, check the totals and see if the totals agree to the figure that is taken in the financial statement, and the figure should be same. If the figure is same, that means it is complete and it is accurate. Cast the NCA register total and subtotal to ensure it is arithmetically correct, arithmetic accuracy. Then one more thing you can do for non-current assets register is randomly pick an item from the register, go in the company and check if that item is there. Okay, so that will confirm existence of the item. Second, you can do the opposite. Go to the factory, randomly select a machinery and see if that machinery is recorded in your books of accounts. Okay, again existence. Inspect assets for the conditions and signs of impairment. Impairment means what? Any write down is required. Now, non-current assets, for revalued assets and for additions, what you will do. What is revalued asset? Every year you revalue the asset and kind of increase it in value or decrease it in value depending on the market value. So a person who revalues the asset is known as the valuer. He's an expert in that field who comes to the company and says that, this bottle right now cost 1 lakh, but it is not that amount. Now the value of that bottle has increased because of the demand. So that is the valuer. So the company suddenly revalues the bottle from 1 lakh to 1 lakh 50. Now I want to design audit procedures for this revalued bottle. So what I'll do, first I'll agree this to the valuer's report, if the valuer has really said so or not. And then agree the stated amount to the general ledger and financial statement. Then, if I have a plant and machinery and during the year I have made some additions to that plant, I have increased the plant, I have made some additions or maybe I have made some deductions. Additions means purchase of new plant and deduction means selling of the existing part of the plant. Okay, so if that is the case, then what needs to be done? If there is addition, select a sample of additions and agree the cost to supplier invoice. That means if the addition has really been done or not. So if you have really done the additions, you will have a bill for the same. So look at that bill and check for how much amount you have made the addition. And agree the cost to supplier invoice. Obtain the list of additions and inspect their descriptions to confirm that they relate to capital expenditure items rather than repairs and maintenance. Okay, so again obtain a list of how much additions have been done to plant and machinery. Inspect the descriptions to confirm that they relate to capital expenditure. That is, addition is a part of capital expenditure, right? Because it is a long-term expenditure rather than repairs and maintenance. So you have to differentiate really if you added items to plant and machinery or you just repaired plant and machinery. Okay, so this is in terms of additions. And for disposals, that is selling of plant and machinery, obtain a breakdown of disposals, cast the assets and agree all assets removed from NCA register. That means if you have really sold the assets, you have to remove it from the register because their existence is now nullified in the business. Then next, select a sample of disposal, agree sales proceeds to supporting documentation. When you dispose of an asset, you get money. Yes, then agree the sales proceeds that you have got to the supporting documentation for accuracy. And whenever you sell a non-current asset, you will either incur a profit or a loss. Whatever it is, you recalculate the profit and loss because the company might say anything that we made a profit of this much, or the company would purposely say that no, we made a loss this time. You cannot trust the company. So you will recalculate it yourself. To recalculate profit or loss on disposal and agree to statement of P&L to ensure it is accurate. So see how beautifully the procedures are designed. The starting mein what I showed you were general procedures. You have to take that general procedures as the base and design your customized procedures. So these are the general procedures. You have to take these as the base and design your procedures according to what is asked to you in the exam. About depreciation, every non-current asset has a depreciation policy. Yes, so what you will do? Inspect the capital expenditure budget for the next few years to assess the useful life in light of plans to replace the asset. So every company has a capital expenditure budget that after 3 years I will buy this, after 5 years I will buy this. So you inspect that and see that what is your plan to replace the existing asset, when are you planning to buy a new asset. Okay, then recalculate the depreciation charge for a sample of assets to verify arithmetic accuracy. Now depreciation is something that is going to be calculated by the company. Yes, but again we're not going to trust whatever the company does. So for a sample of assets, we're going to recalculate and see to verify the arithmetic accuracy. Then inspect the depreciation charge and policies in draft financial statement and compare it to prior year to ensure consistency. Now, depreciation is something that the method that you're using for depreciation has to be consistent over the years. Every year, you cannot get up and say, no, this year I'm doing straight line basis. No, this year I'm doing reducing balance method. It's not allowed as per the policies. So, company will do anything, but as an auditor, what will be your procedures to make sure that the current year depreciation policy is consistent with the last year? You have not changed the policies. You can change it one time or the other, but you cannot keep on changing it every year. So as an auditor, you need to make sure that the current year depreciation policy is very consistent with the last year depreciation policy. Okay, that you need to make sure. Okay, then audit procedures on intangible non-current assets. What are intangible non-current assets? Intangible non-current assets are something that you cannot see, but they have immense value. For example, license. Yes, we have patents, we have copyrights, and we have trademarks. You cannot see a patent, you cannot see a copyright, you cannot see a trademark, right? But it has immense value. So intangible asset is something which you cannot see, but it has value. So what are the audit procedures for that? For example, development cost. So first of all, you cannot see the development cost, but it is there. So first step is obtain a breakdown of cost capitalized, cast for mathematical accuracy, and agree to the amount included in the financial statement for valuation and completeness. So what you will do, you will break down the cost capitalized as development cost. Then you will actually confirm if the entire cost is for development or part of it is a research cost. Okay, basically you will split the cost between research and development, because development cost is to be capitalized, but research cost is to be expensed in the P&L. So you will do that. You will obtain a breakdown of the cost capitalized and you will split it between development and research. Then for a sample of cost, agree to invoices or timesheets. Any cost can be included in this. So you will agree the cost to the invoices if you have a proper bill of the same or your timesheets. Then in the board, there might be discussions of various things about the intangible items. Maybe the directors are talking about purchasing a new patent, purchasing a new trademark, purchasing a new copyright, or selling one of them and getting a lot of money. Yes. So all this information, how you will get as an auditor, because you cannot attend the board meeting, because the board meeting has to be between the board of directors. But the auditor can do one thing. The entire board minute is recorded as minutes. So every minute what discussion is there, it is recorded. So as an auditor, what you can do is you can inspect the board meetings for any discussions related to the intended sale or use of the asset. Okay, you can inspect the board minutes for any discussions relating to the intended sale or use of the asset. Then for patents, copyrights and trademarks, I have purchased the patent, so I have paid the money. So inspect purchase documentation to make sure that I have purchased. One more point I can add here, inspect the cash in bank to ensure that I have made the payment for that patent, really if I have made the payment. Patent, copyright and trademark have certain valuation. So inspect specialist valuation report and agree to the amount included in the general ledger and the financial statement for valuation. Okay, so patent, copyright and trademark have immense value, but that valuation cannot be done by anybody. You need to have a specialist to value the intangible asset, because it's not like valuing a tangible asset, because you cannot see it, but it has immense value. So the calculation is a little different from what you do for normal tangible assets, which you can see. and looking at the condition of it and all, you can find out the value. But here you cannot see the items, you cannot see a patent, you cannot see a copyright, you cannot see a trademark. So finding out the value of that becomes a little difficult. So you have to rely on the valuation expert or a specialist. So inspect the specialist report and see what is the valuation of that. Then like tangible assets are depreciated, intangible assets are amortized. That is, after a few years the value becomes less. That is known as amortization. So for amortization, what will you do? Inspect the budget's forecast for the next few years to ascertain the period over which the economic benefits are expected to be generated. Like for tangible assets, if I want to calculate depreciation, first I should know the life of the asset, and depending on the life of the asset, I will split the depreciation. Similarly, for intangible assets, whenever I want to calculate amortization is like a depreciation of intangible assets. So I need to know the period over which I will get economic benefits from the patent, copyrights and trademarks. Once I know that, then I can amortize the intangible assets. Then recalculate the amortization charge to verify arithmetic accuracy. Okay, recalculate why? Like we recalculate depreciation for a sample of items. Similarly, for a sample of intangible assets, I will recalculate the amortization to verify that it is arithmetically accurate. For intangibles such as license, inspect the license agreement to confirm the amortization period corresponds to the license period. Now, license is something that you get for a specified period of time. You inspect the license record to see that the period that is given on the license and the period for which you have amortized it is same. It has to be same. Then goodwill is also intangible asset which you cannot see. Yes, but it is there in the business. Yes. So what will you do for goodwill? Audit procedures. Agree the consideration to sales agreement by inspection. You will come to know by the consideration that you have paid in the sales agreement about the valuation of goodwill. Consider whether asset valuation is reasonable by obtaining an expert report. Yes, I think there should be an expert to value goodwill because we are not experts in valuation of goodwill. But you yourself also can recalculate things and find out if the calculation is correct. Then audit procedures for inventory. Inventory, stock that we have. Evaluate the management's instructions and procedures for the inventory count. We have to count the inventory. Yes, we can do it either by perpetual method or we can do it by periodic method, whatever suits you. But for any method that you're following, management gives instructions for that method. So you evaluate the instructions given by the management for that. Observe the performance of the count. Yes, how the count is undertaken. As an auditor, it's your duty to see if the management is doing their work properly in terms of performance of the count. Inspect the inventory. Yes, see the inventory, check the inventory that it is proper and perform test counts. Before the count, what will you do? Inventory procedures before the count. Before the count, all the instructions are ready. That when the count starts, these are the instructions that the counter has to follow. So contact the client and you also obtain a copy of the instructions so that you know when the count starts what the company is going to do. If you don't obtain the instructions prior, you will be shocked on the day of the count that what are they doing, what are they counting. So it's better that as an auditor you have an idea that okay, these are the instructions that are to be followed while counting. Okay, then inspect prior your working papers to understand the inventory count process and identify any issues need to be taken into account this year. Inventory has been counted last year also. Inventory is to be counted this year also. You get an instruction for what is to be followed for this year, but along with that, also inspect prior your working papers. What are prior your working papers? Working papers give you an idea of how the inventory was counted prior year. Okay, how the inventory was counted prior year. So with that, you will get an idea of last year what were the procedures and this year what are the procedures. Okay. Then book audit staff to attend inventory counts. Convince the audit staff कि नहीं, you have to attend an inventory count. If there are 10 warehouses, at least you can cover 60 to 70%. So your detection risk also decreases. Yes. Then this is before the count. Then during the count, what you will do? During the count, the real work takes place. There are inventory count sheets. On the count sheets, you have to mark what portion of the warehouse you have already counted. So you can obtain copies of the inventory count sheets at the end of the inventory count and agree it to the final inventory listing for completeness and existence, to make sure that you're following the instructions from that sheet, the count instructions, and you're really applying that count instructions there. Okay. Then one thing you can do is, you have counted the inventory and noted it on that count sheet. So randomly select an item on count sheet, go and see if it is really there in the inventory. That means your count sheet is correct, and you can do vice versa also. Randomly pick an item from the physical inventory and trace it to the inventory records to see if it is existence. And after the count, what you will do? You will check the arithmetical accuracy of the count, if the count is done properly, and inspect the purchase invoices for a sample of inventory items to agree to their cost. So this is something that you will do after count. Now we take a break of 5 minutes, after which we will continue. Okay, so the after count thing is done. Next we have is on receivables and prepayments. So what you will do, obtain an aged receivable listing, that is all the old receivables listing, cast it and agree the total to financial statement to make sure that the items are accurate. Agree the receivable ledger control account with receivable ledger list of balances for completeness and accuracy, and select a sample of year-end receivable balances and agree back to valid supporting documentation of the GDN and sales order existence. So this is something that you will do in terms of receivables and prepayments. Okay. So then I think now we are ready to solve the questions. Right. So let's once again go to the ACCA Study Hub. Select your subject from your, yes, I have taught you how to do that. And yeah. So this is the third category of questions that I was talking about. Jasmine Company. Okay. Now please take time to read this requirement. Till then, I will quickly check if there are any comments on our YouTube live so that I will understand if anybody has a doubt. So I'll quickly check the comments and get back. And for those who are watching the recordings, after that also, if you have a doubt, you can post it in the comments later, because I normally keep on checking the comments. So yeah, I will be able to solve it. So we're doing Jasmine. So please read the requirements. Okay, so let's start reading it. Part A, describe substantive procedures the auditor should perform to obtain sufficient and appropriate audit evidence in relation to Jasmine Company's trade receivables. So we want substantive procedures first on what? Trade receivables for 5 marks. So 5 very good points or 7 okayish good points. Okay. B, describe substantive procedures the auditor should perform to obtain sufficient and appropriate audit evidence in relation to Jasmine Company's bank balance. Next, describe the audit procedures the auditor should perform in assessing whether or not the Jasmine is a going concern. And D, discuss the issues and describe the impact on the auditor's report of Jasmine Company of adequate and inadequate going concern disclosure. So now can we read the question? Jasmine Company. It is 1 July 20x5. Jasmine Company manufactures motor vehicle components and its year end was 30th April 20x5. You are an audit supervisor of Peppermint and Company and the final audit is due to commence shortly. Total assets are $43.2 million and profit before tax is $7.2 million. The following matters have been brought to your attention. First one is trade receivables. Jasmine Company's trade receivables are comprised of a large number of customers. In previous years, the audit team has undertaken a positive trade receivable circularization to confirm year-end balances. However, the customer response rate has historically been low, and so alternative audit procedures have been undertaken. A decision has been made that for the current year audit, a circularization will not be performed. The year-end trade receivable balance is $3.9 million and last year it was $2.8 million, and the allowance for trade receivable is $410,000 and last year it was $3 lakh. Next is regarding bank balance. The bank and cash figure included in Jasmine Company's draft financial statement is comprised of a number of bank account balances. An overdraft of $5.1 million, which is the company's main current account, and $0.2 million relating to several saving accounts. The finance director has informed the audit manager that all accounts have been reconciled as at the year end. The overdraft of $5.1 million has increased significantly since the prior year. Prior year it was $1.2 million. This year it is more than double. The directors have informed you that the overdraft facility, which the company requires in order to operate on a daily basis, is due for renewal in August 20x5 and that they are confident it will be renewed. So first let's solve substantive procedures on receivable. So we'll take information from receivable and solve that. So plan your response here. This is the fourth. Okay, so what is that on trade receivable? So just now we saw so many procedures, right? You can write depending on the question. So once again I'll read trade receivables. Trade receivable. Jasmine Company's trade receivable are comprised of a large number of customers. That means there are a lot of receivables. In previous years, the audit team has undertaken a positive trade receivable circularization to confirm year-end balances. So they have taken a circularization from outside people to confirm their balances. However, the customers have not responded. The company is trying their best to ask the people that how much is receivable, confirm and tell us, but the response rate has historically been low and so alternative audit procedures have been undertaken. And because of the past result, which is not that great, that people are not responding about their receivables and all, this year the decision has been made that circularization will not be performed. Year-end trade balances 3.9, last year it was 2.8, and the allowance this year is 4 lakh 10, last year the allowance was 3 lakh. Now there is a trade receivable from many customers. In previous years you had undertaken a drive that you send confirmation letters to people and people should confirm their balance that yes, this much is receivable by me, this much is receivable from the company and that. But the response rate has been very bad. So this year the company is not doing that. So what will be your procedures, substantive procedures for trade receivables? First of all, the first thing that you will do is obtain first thing that you will do is obtain the aged receivable listing and agree the balance on trade receivable account and trial balance. For what is this? To make sure that the balance on the aged inventory listing and the balance taken to the trade receivable and trial balance is same. So this will give you an idea of accuracy. Next, review customer correspondence to identify any balances which are in dispute or unlikely to be paid and discuss with management. What does that mean? The company has receivable from a customer A. Company has 1 lakh receivable. So go and ask the customer A, is it true that you have to pay 1 lakh to the company? Mr. A will say, no, I'm not going to pay. What is this? It's a dispute. So review customer correspondence to identify if there are any disputes in any balances and discuss the same with the management, because a lot of times people don't want to pay the money. So they will say, no, forget about it. I am in liquidation. I am facing bad debts. I will not pay the money. So this is the money in dispute. Okay. Then what is one of the best things to do? As an auditor, we don't know what is the discussion that is going on in the company regarding any kind of receivables. So what you will do? The best way to find out about what discussions are happening in the company is by reviewing the board minutes. So review board minutes to identify whether there are significant concerns in relation to payments by customers. Because if the customers are not agreeing to pay and the customers are saying we are not going to pay your money, the first thing that happens is there's a discussion in the management that so and so customers don't want to pay and etc. What needs to be done? We will be under losses. So if the auditor wants to know about all of that, he has to just review the board minutes to know about what is the discussion that is going on. Then next, calculate the average receivable collection period and compare this with prior year and investigate any significant differences. Because we have current year receivables, we have last year receivables, we have current year balance, we have last year balance. So using both the balance, calculate the average receivable collection period. Yesterday I showed you the formula also of the same, and compare it with last year and see if there are any significant differences as compared to last year. So that will give you an idea of, is the company proceeding ahead or is it coming back? Then the entire trade receivable has to be broken down into components. Yes, so the next one. obtain a breakdown of the allowance for trade receivables, recalculate and compare to any potentially irrecoverable balances. For what? To assess if allowance is adequate. So you will break down the allowance of trade receivable, recalculate a part of it, and make sure that the allowance is adequate. So how much are done? 1, 2, 3, 4, 5. We'll try 7. Okay. What else can you do? You will inspect the post year-end cash sales returns. You will inspect the post year-end sales return and see if allowance for receivable needs to be more. Because last year the allowance was 3 lakh, this year it is 4 lakh 10. So is 4 lakh 10 perfect or you require more? That depends on the credit sales, right? So inspect post year-end sales returns or credit notes and consider whether an additional allowance against receivable is required. Okay, then what else you can do? On a sampling basis, you can select one of the receivable of the multiple receivables that you have and agree it back to the valid supporting documentation. Okay, so next one is select a sample of year-end receivable balance and agree back to valid supporting documentation of sales invoices. And along with sales invoices, compare it with goods dispatch notes also and sales order to ensure existence. Okay, so this becomes your 7 points for 5 marks. If you have a limitation of time, then you can just write 5 good points. It will give you 5 marks. Okay, this is the first one. The second one we have is substantive procedures on bank balances. That is, you want to confirm and check the bank balances. So for that, let's read once again the bank balance. The bank and cash figure included in Jasmine Company's draft financial statement is comprised of a number of bank account balances, an overdraft of $5.1 million, which is company's main current account, and $0.2 million relating to several saving accounts. The finance director has informed the audit manager that all accounts have been reconciled as at the year end. The overdraft of $5.1 million has increased significantly since the prior year. That is, prior year the overdraft was 1.2, now it is more than double of it. The directors have informed you that the overdraft facility which the company requires in order to operate on a daily basis is due for renewal in August 20x5, and they are confident that it is going to be renewed. So let's write. The first thing what you will do, you will obtain a bank confirmation letter confirming that actually there is an overdraft balance in the bank. Yes, so that is the first step. Obtain a bank confirmation letter from Jasmine Company's bankers for all of its accounts. One step, very simple and very easy. Then all the accounts that are listed on the bank confirmation letter, you have to reconcile it back to the trial balance if they are included in the trial balance of the company. So second one is agree all accounts listed on the bank confirmation letter to the company's bank reconciliation or the trial balance or general ledger to ensure completeness of bank balances. So you will agree the accounts listed to the trial balance and general ledger. Then whatever is the balance that the company tells us that I have this much balance in bank, I have this much balance in overdraft, are you going to listen to it just like that? Or are you going to do your own research for accuracy? Yes, we're going to do our own research. So, for current account, obtain Jasmine Company's bank reconciliation and cast to check the additions to ensure arithmetical accuracy, right? Then next, you have to compare if the same balance which the bank is saying that same is included in the books of accounts. Yes, there is no difference in the balance. Whatever the bank is saying is the overdraft balance, or whatever the bank is saying is your balance, that much is only included in your books of accounts. So next point can be about that. So agree the balance as per the bank reconciliation to an original year-end bank statement and to the bank confirmation letter. Right? Then that you agreed the balance as per the reconciliation to your bank confirmation letter. Then you have to again agree the reconciliation to the ledger account. Yes, because ledger account is what you're preparing in the company. So again, same point but a different way. Agree the reconciliation balance for the bank ledger account to the year-end bank ledger account. Right? Then there are certain outstanding bank balances. You have to record it appropriately depending on it. It will come in post year-end bank statement or pre-year-end. So any bank balances pertaining to last year will come in last year. Any balances pertaining to this year will come in this year. So how many points are done? 1, 2, 3, 5. Yes. So that can be done 1. What else can you do? If somebody gives you a check and for a very long time you don't present the check into the bank, the check gets expired. Yes, so you need to write back those checks. So that is a very important point in bank balance, because a lot of times the check just goes out of expiry and then you cannot produce it into the bank. So examine any old unpresented checks to assess whether they need to be written back as they are no longer valid to be presented. Yes, any old unrepresented checks and which are not valid, so you need to write them back. Then what else? When you take a loan or when you take an outstanding balance, you keep some security with the bank, like maybe some property or maybe some gold. So that also needs to be written down, and that details you will get in the bank confirmation letter. So examine the bank confirmation letter for details of any security provided by Jasmine Company with regards to bank overdraft or any legal right of set off, as this may require disclosure. Okay, so that is enough for 5 marks. Then part C, audit procedures that the company should perform to assess whether or not a company is a going concern. Now, to my dear students from my live class who are attending the YouTube revision, are aware that we had done going concern procedures. So whenever this things happen, that means the company is under difficulty and there is a going concern problem. So when you see at the company's cash flow forecast, or you see the company's cash flow, or you understand the company has sufficient cash, that means it can survive. If it doesn't have, that means it cannot. Then you can conduct a sensitivity analysis to see how sensitive the company is to changes. If it's very sensitive, so it might have going concern issues and all of that. So next one is going concern procedures. Now for this there is no separate paragraph, but overall question padke you have to determine, see the assets comparison and receivables and bank balances ke basis pe you have to provide if the company is a going concern or not. So the first one, what you will do in terms to determine if the company is a going concern or not, you will talk about the cash flows first. Obtain the company's cash flow forecast and review the cash inflows and outflows assess the assumptions for reasonableness and what you will do, discuss the findings with management to understand if the company has sufficient cash. With that, what will you understand? That means if the company has sufficient cash, it will be able to conduct business in the long run. If it doesn't, then it might face going concern issues. Then I told you, you have to perform sensitivity analysis to check how sensitive your company is to changes. So perform sensitivity analysis on the cash flows to understand the margin of safety, MOS, the company has in terms of its net cash inflow or outflow, right? Then if you want to really find out about the going concern of the company, you need to know what plans the management has in the future in relation to how to obtain further finance if they want to run a company, or if they are planning for an expansion, then in that case how they are planning to obtain the finance. So evaluate management's plans for future actions including their contingency plans in relation to ongoing financing and plans for generating revenue like plan anybody can make. Everybody can make a plan, but what is the feasibility of the plan? Is it going to work out or not? So, and consider the feasibility of these plans. Then you can review the sales of the company to see where you have reached as compared to last year. If your sales are going up, that means you will not have that many cash flow difficulties, which will have difficulties in going concern. So basically you have to check if the levels of trade are likely to increase. So review the company's post year-end sales and order book to assess if the levels of trade are likely to increase and if the revenue figures in the cash flow forecast are reasonable. Then whenever the company obtains a loan, there are certain covenants that need to be met. Yesterday we solved a question where there was a minimum profit covenant, and if that covenant is breached, the loan becomes instantly repayable. So like that, if you have breached any covenant and the loan becomes instantly payable, you need to have that much money to repay the loan, and if you don't, it is going to affect your going concern. So the next point is about that. So you can say review any arrangements with the bank to determine whether any covenants have been breached, especially in relation to overdraft, right? Two more. You currently have an overdraft. Last year and this year, the overdraft is a massive, it's more than double. So what do you think? Next year again, will the bank give you an overdraft, or will they stop it there at 5.1? So that also. Review any bank correspondence to assess the likelihood of the bank renewing the overdraft facility. Okay. Then one more going concern issue that arises is if anybody files a legal case on the company, and the result of the legal case is if the company fails, the company has to pay a huge sum. So is there any legal case as such on the company which, if the company loses, the company has to pay a lot of money, and if they don't pay that money, they will be sued for the same. They have to pay that money, and if they don't have that money, they have to close down the business. So this is one more going concern issue, and that you can obtain information from the company's lawyers. Okay, but you cannot contact the lawyers directly. If you want to contact the lawyers, you have to contact them with the permission of Jasmine. So with the client's permission, inquire of the lawyers of Jasmine Company as to the existence of any litigation, and if so, likely outcome of any litigation. Okay. Then our favorite, if you want to find out about any issue that maybe the company doesn't want to share with the auditors, but within the problem is going on and the discussions are going on. So how will you understand about the problems? Simple, by reviewing the board minutes. So review the board minutes to identify any other issues which might indicate further financial difficulties for the company. Okay, so that's for 5 marks. And then the D part, discuss this issue which is given above and describe the impact of that issue on the auditor's report of Jasmine Company of adequate and inadequate going concern disclosures. During the final audit, the finance director has informed the audit team that Jasmine Company's bankers will not make a decision on the renewal of the overdraft facility until after the auditor's report is signed. The audit engagement partner is satisfied that the use of the going concern basis is appropriate. The directors have agreed to include some brief going concern disclosures in the financial statement, and the audit team still have to access the adequacy of these disclosures. So renewal of the overdraft facility, the bankers will not make a decision on that. So how will it affect the audit reports? First of all, discuss the issue and then the disclosure required and the result of inadequate disclosure. So first of all, discuss the issue. What is the issue? Renewal of the overdraft facility. Now, if the bank will renew the overdraft facility or not for next year, we will come to know about it in next year only. Now, while I'm signing the auditor's report, I will not know what bank will do next year. The bank can agree also, the bank cannot agree also. So how will I know? Okay. So, as the outcome regarding the negotiations for the overdraft facility renewal, will not be known at the time of signing the auditor's report. There is a material uncertainty which may cast significant doubt on the company's ability to continue as a going concern. Because if the bank does not renew the overdraft facility, it will be difficult for us to carry on the business because we don't have that much cash flow with us. So continue as a going concern. So the impact on the auditor's report depends on whether the uncertainty is deemed to be adequately disclosed in the financial statements. So if the disclosure is adequate, then what? And if the disclosure is inadequate, then what? You can write it as a part of a table, or you can write it like I'm writing it. So disclosure adequate. So there is adequate disclosure, then what? If the disclosures are adequate, then what? Then the auditor's report will need to include a material uncertainty related to going concern. Because if the bank cancels the overdraft, we really have an uncertainty relating to going concern. Then in the same one you will write, the section will state that the audit opinion is not modified indicate that there is a material uncertainty related to and a disclosure note also. So and a disclosure note made by management, right? And once you give your opinion which is not modified, you also have to give a basis for your audit opinion, so that would also be there. So it would be included after the opinion and basis for opinion paragraph. Okay, then next we have, if the disclosure is not adequate, means the management has not disclosed it appropriately, then how will it affect? So disclosure is inadequate. Now whatever I'm writing this, I'm not writing it from the question, but I'm writing it with whatever prior knowledge that I have obtained when I studied the chapter reporting. So when I studied the chapter reporting, I studied in that if the disclosure is adequate, then what will happen? And if the disclosure is inadequate, then what will happen? So if the disclosure by the management is not adequate, the audit opinion will be modified. There the disclosure was adequate, so it was not modified. Here the audit opinion will need to be modified as there is a material misstatement relating to inadequate disclosure. But this matter will be material and pervasive or material and not pervasive. Obviously, it will be material and not pervasive because this will affect only that area and not the entire financial statement. So, the failure to adequately disclose is likely to be material but not pervasive. And whenever the matter is material but not pervasive, what kind of opinion is there? It's a qualified, that is except for opinion. So except for that area, the financial statement is perfect, true and fair. So but not pervasive due to the ongoing nature of the negotiations, and so a qualified opinion will be issued. What is a qualified opinion? So the opinion paragraph will state that except for the failure to adequately disclose, so except for this matter, that is the disclosure matter, the financial statements give a true and fair view. And once you give the opinion, you also have to give a basis for opinion. So the report will contain a basis for opinion paragraph, subsequent, that is after the opinion paragraph. So if the disclosure is adequate by the management, the audit report will be unmodified, that is the financial statement show a true and fair view. If the disclosure is inadequate, then the auditor will give a qualified, that is an except for opinion. So once you confirm the answer, this is your answer that you just wrote, and this is the standard answer. You can always compare your answer with the standard answer and see where you're lacking. Okay, so that's with this particular question of Jasmine Company, which was completely on substantive procedures. Okay, so you can always review this and see. Now I'm taking a break of 10 minutes, after which we'll do the second question. Okay. Okay, so that question is over. Then the next question we have is, again we have to take from this. So I'm planning to take the Hyacinth company. So again, substantive procedures on valuation, substantive procedures on research and development, substantive procedures on sales tax liability, and this one. So again, a very similar question. Yes. Please read the requirement. Until then, I will check the comments. Okay, please read the requirements. So we have okay. So let's read the requirement first and then read the question. So describe substantive procedures the auditor should perform to obtain sufficient and appropriate audit evidence in relation to the valuation of Hyacinth Company's inventory. Then second, describe substantive procedures the auditor should perform to obtain sufficient and appropriate audit evidence in relation to Hyacinth Company's R&D expenditure. Then next, for 6, 4 and 4 marks. Describe substantive procedure the auditor should perform to obtain sufficient and appropriate audit evidence in relation to Hyacinth Company's year-end sales tax liability. And D, you have 2 parts. Explain whether the 20x5 financial statement of Hyacinth Company require amendment in relation to the flood, but it is a non-adjusting event, and because floods is something that you had no idea about at the year end. If you had an idea, you would have done something to stop it. Describe audit procedures which should be performed in order to form a conclusion on any required amendment. So Hyacinth Company, it is 1 July 20x5. Hyacinth Company develops and manufactures computer components, and its year end was 30th April 20x5. The company has a large factory and 2 warehouses, one of which is off-site. You are an audit supervisor of Tulip and Company, and the final audit is due to commence shortly. Draft financial statements show total assets of $23.2 million and profit before tax of $6.4 million. The following 3 matters have been brought to your attention. Inventory valuation. Your firm attended the year-end inventory count for Hyacinth Company and confirmed that the controls and processes for recording work in progress and finished goods were acceptable. Work in progress and finished goods are both material to the financial statements, and the audit team was able to confirm both the quantity and stage of completion of work in progress. Before goods are dispatched, they are inspected by the company's quality control department. Just prior to the inventory count, it was noted that a batch of product line Crocus, which had been produced to meet customers' specific technical requirements, did not meet the customer's quality and technical standards. The inventory had a production cost of $450,000. Upon discussion with the production supervisor, the finance director believes that the inventory can still be sold to alternative customers at a discounted price of $90,000. Then R&D, research and development. Hyacinth Company includes expenditure incurred in developing new products within intangible assets once the recognition criteria under IAS 38 intangible assets have been met. Intangible assets are amortized on a straight line basis over 4 years once production commences. The amortization policy is based on past experience of the likely useful lives of the products. The opening balance of intangible assets is $1.9 million. In the current year, Hyacinth Company spent $0.8 million developing 3 new products, all at different stages of development. And according to IAS 38, only assets that meet this development criteria can be capitalized. Then sales tax liability. Hyacinth Company is required by the relevant tax authority in the country in which it operates to charge sales tax at 15% on all products which it sells. The sales tax is payable to the tax authority. When purchasing raw materials and incurring expenses in the manufacturing process, the company pays 15% sales tax on its items purchased, and this can be reclaimed from the tax authority. The company is required to report the taxes charged and incurred by completing a tax return on a quarterly basis, and the net amount owing to the tax authority must be remitted with 4 weeks of the quarter end. The financial statements contain a $1.1 million liability for sales tax for the quarter ended 30th April 2025. Once again, requirement A, substantive procedures and valuation of Hyacinth's inventory. So, let's start planning the answer. This is the A part, which is inventory valuation. Now we already saw substantive procedures for inventory valuation when we were doing the revision. Yes. So write whatever you have read, based on that you write down. So the first one is breakdown of work in progress. Yes, so obtain the breakdown of work in progress and agree a sample of work in progress assessed during the inventory count to the work in progress schedule then agree the percentage of completion to that recorded at the inventory count. Okay, then next, for a sample of inventory items of finished goods or work in progress, you have to agree the relevant cost sheets and agree the raw material cost to the recent purchase of invoices. That means whatever cost is included, that I purchased this bottle for 100 rupees or something 200, is it the same cost that is included in the invoice? So you write that. So for a sample of inventory items obtain the relevant cost sheets and agree raw material cost to recent purchase invoices labor cost means what? The cost that you're paying the labor to timesheets. You'll agree the labor cost to timesheets, like for how much labor is paid on the number of hours that they give. So the labor cost that you pay the labor will be compared to the timesheets, how much time he has worked for, and the payroll records. Timesheets or payroll records and confirm overheads allocated are of a production related nature. Okay. Then you have to examine if any items have been written and returns, and which could signify a write down in the inventory valuation. So that is the next one. Examine post year end credit terms to determine whether there have been returns which could signify that a write down is required. It's for how many marks? 6 marks. Okay. Then what else can you say about inventory valuation? Inventory is valued at what? Cost or NRV, whichever is less, according to IS2 inventories. So confirm if that is happening, if you have really valued the inventory at cost or NRV. So select a sample of year-end finished goods and compare cost with post year-end sales invoices to ascertain if NRV, that is net realizable value, is above cost or if an adjustment is required. Okay. Then work in progress need to be valued on certain grounds. Is the work in progress valuation appropriate? So discuss the basis of WIP evaluation with management, that is on what basis the management has valued it, and assess its reasonableness. Okay. then you know that in a particular business, if there is any old, aged inventory, slow moving inventory, then it needs to be written down, because inventory is valued at the lower of cost in NRV, in which case the cost is usually the lower, but when you have old inventory, the NRV becomes less because it is obsolete inventory. So for aged inventory, review aged inventory reports, and identify any slow moving goods discuss with management why these items have not been written down or if an allowance is required. Six points are done, but we'll write one more. Then there's a product corpus. So if any corpus product has been sold post year end, then review the sales invoice confirming the same. So if any corpus products have been sold post year end, review the sales invoice to assess NRV. Okay, is that clear? That is regarding inventory valuation. The second one we have is substantive procedures on R&D, research and development cost. So that is the B part. See, you need to have the basic points in your mind. What were the basic points I told you about? Inspection, observation, inquiry, external confirmation, recalculation, reperformance, and analytical procedures. That is analyzing the relationship between information for any differences. Research and development. So go through that for once. First thing is you have to cast the schedule. So obtain and cast a schedule of intangible assets agree the closing balances to the general ledger trial balance and draft financial statements. Okay. Now the finance director has said that the useful life is 4 years. But on what basis the director has decided this rationale of having a 4-year useful life? discuss with the finance director. So discuss with the finance director rationale for the 4-year useful life and consider its reasonableness. Okay, then they've calculated the amortization charge, but as I told you, you will not listen to anything that the management says, but for your own thing you will recalculate it. Yes, so recalculate the amortization charge for a sample of intangible assets which have commenced production and confirm that it is in line with the amortization policy of straight line over 4 years, and that the amortization commenced from the point of production. Even depreciation should commence when the asset is ready for use, the time of production, because it is the wear and tear. Then new products are developed. So for the new computing software projects, discuss with the management the detail of each project. And at what stage of development they are. So depending on that we can classify the cost. So for the new computing software projects, discuss with management the details of each project along with the stage of development and whether it has been capitalized or expensed. Okay, for this new software projects. Then for those capitalized it's okay, but for those expensed at research, agree to the supporting documentation that you have expensed those. So first of all, for those expensed and for those capitalized, both you write. So for those expensed as research, agree the cost incurred to invoices and supporting documentation and to inclusion in P&L and for those capitalized as development, agree cost incurred to invoices. Okay, so that is research and development. Then next we have is sales tax liability. So just go through this. Sales tax liability, yes. First step is agree the year-end sales tax liability in the trial balance to the tax return submitted to the tax authority and cast reconciliation to see that it is the same. Now this is for 4 marks, right? So 6 points are enough. So for the quarterly sales tax charged, next point will be based on that. Agree the quarterly sales tax charged equates to 15%. Of the last quarter sales as for the details sales day testing. Okay, then recalculate the sales tax. Yes, because as an auditor we need to recalculate the sales tax incurred as per the reconciliation is equal of the final quarter's purchases and expenses as per the detailed purchase listing. Okay, then next, what is the amount payable to the tax authority? Sales tax charged less how much is incurred. So agree to that also. Recalculate the amount payable to the tax authority as being sales tax charged less sales tax incurred. Then whatever is this year's sales tax, you compare it with the prior year to see if there are any significant differences. Yes, analytical procedures. So compare the year-end sales tax liability to the prior year balance or budget and investigate any significant differences. And one more. As an auditor, what you can do is, instead of asking everything to the management, you can take one external confirmation also. So review any current and post-year-end correspondence with tax authority to see if any balance is outstanding. So review any current and post-year-end correspondence with the tax authority to assess whether there are any additional outstanding payments due, and if so, that is if the payments are due, confirm they are included in the year-end liability. Okay, so that's with the C part. And what is the D part? Fire took place, something like that, right? Explain whether the 20x5 financial statement of IIC company require amendment in relation to the flood, not fire, and describe audit procedures which should be performed in order to confirm a conclusion on any required amendment. So first of all, it is an adjusting event, is something that we have, it's a subsequent event, that's something we have understood. Okay, now the audit is now almost complete and the auditor's report is due to be signed shortly. The following matter has been brought to your attention. On 3 June 2005, a flood occurred at the off-site warehouse. This resulted in some damage to the inventory and property, plant and equipment. However, there have been no significant delays to customer deliveries or complaints from customer. IIC company's management has investigated the cause of the flooding and believes that the company is unlikely to be able to claim on its insurance. The finance director of IIC company has estimated the value of damaged inventory and property, plant and equipment was 0.7 million and that it now has no scrap value. So it's a subsequent non-adjusting event because it's a flood, and if you had known about it before, you would have obviously worked hard so that the flood had not occurred. So the first thing is that it is a subsequent event. Okay, so a flood has occurred at the offsite warehouse and property, plant and equipment and inventory valued at how much? 0.7 million. Have been damaged and now have no scrap value. The directors do not believe they are likely to be able to claim on the company's insurance for the damaged assets. This event occurred after the reporting period, that is a subsequent event, and is not an event that includes condition that existed at the reporting date. That means it is a non-adjusting event, not an event which provides evidence of a condition at the year end, and so this is a non-adjusting event. That's what I told you at the beginning, and the same you have just elaborated and written it down for marks, obviously. Okay, now the next paragraph about the 0.7 million, because the next part we have to see is we have to address the materiality of that, and checking if it's material or not, we'll discuss it further that what to do with that. So 0.7 million, you will compare it with profit before tax and with total assets. So keep your calculation ready. The damaged asset of $0.7 million represents 0.7 divided by profit before taxes 6.4 and assets is 23.2. Okay, 6.4 million. So it is represents how much? 3.0% are again material. So as a material non-adjusting event, the assets do not need to be written down to zero in this financial year. So first we saw about the event, then we discussed the materiality of that, and after you found out that it is material, then what needs to be done? Disclosure note. The directors should consider including a disclosure note detailing the flood and the value of asset impacted, because it's a non-adjusting but it's material. So when non-adjusting event becomes material, you have to disclose the same. Impacted. And the next requirement is what? Audit procedures on the same. So audit procedures to form a conclusion on any amendment. Okay. So the first one is first of all, check in the book of accounts what is the real value of assets which have been damaged and confirm the total to the value of assets affected, so that sometimes the management, just to get an insurance claim, overstates the value of asset affected, like 0.7 million. Maybe it's not even that much. So confirm that first. So obtain a schedule showing the damaged property, plant and equipment and agree the net book value to the non-current assets register to confirm the total value of assets affected, whether it's proper or the management has just overstated it. So how many marks is it? Total for 6 marks. You can write 4 of it. Then the management is saying that the condition of assets affected is really bad, but you will also confirm from your end if it's the truth. So review the condition of other PPE and inventory to confirm all damaged assets identified. Then does the damaged asset require zero scrap value assessment? So discuss that with the management. So review the damaged PPE and inventory and discuss with management the basis for zero scrap value assessment. Then flood is a non-adjusting event, but you have to disclose the same because it's material. So ask the management if they have disclosed it or they have skipped it altogether. So discuss with the management whether they will disclose the effect of the flood as a non-adjusting event in the year-end financial statement. And that's with the audit procedures. So that completes this particular question. 20 marker, 46.22 minutes. 20. We took 10 minutes extra because obviously I was explaining you the parts and all of that. But if you know you're just doing it, you need to do it in the time frame. Don't take any extra time to do it whatsoever. Here I was explaining to you and doing it, so I took a little bit more time. So I hope you guys have now understood how to write the substantive procedures. So day 2, I taught you audit risk and auditor's response. Day 3, I taught you deficiencies, control, test of controls, control strengths, test of controls, control weaknesses and recommendation. And day 4, yes, I taught you substantive procedures, audit procedures, analytical procedures. These 3 categories which I taught you on day 2, day 3 and day 4, very important. In the examination point of view, very, very, very important. Now MCQs is something that I have left on your part because these are theoretical MCQs. It's not like other subjects where you have to solve and get the answer. So that you will have to do on your end. Tomorrow's same time live, I'm going to take a mock on the constructive workspace, which looks exactly like the exam. Please attend tomorrow's live. It's very, very important. All 3 categories are done. Now we're going to solve a mock. And depending on the time frame that we have available, we'll solve as much as we can. So we'll start with section A and let's see how we can go. Okay. So that's with this particular lecture. I hope you guys enjoyed the live. See you tomorrow at the same time to do the mock. Thank you so much, guys. It was great to teach you all of this. Once you press confirm, you get your answer and the standard answer. So you can always compare and see where you stand. Okay. So thank you so much, guys.